Imagine beating Wall Street's profit expectations by, over 200%,
Oh, wow.
right? Posting an adjusted EPS of $1.48 when the street was looking for just 47 to 51 cents.
That is a massive beat.
It is. But here's the catch. Your actual sales barely budged. They landed essentially in line at $136.3 million, which is up about 9.9% year over year.
So they basically just met expectations on the top line.
Exactly. They slightly beat the low-end revenue estimate, but missed the high-end forecast of $136.9 million.
Interesting.
And this is the bizarre reality Karat Packaging, ticker KRT, reported for Q2 2026.
Yeah, those are some really mixed signals to parse through.
Definitely. And looking ahead, management expects Q3 net sales to grow in the low double digits, with gross margins normalizing to somewhere between 35 and 37%.
Right, and adjusted EBITDA margins between 9 and 11%, I think.
Yep, you got it. And for the full year, they're targeting that same low double-digit sales growth, low 40% gross margins, and, mid-teens adjusted EBITDA margins.
So how did the market react to all that? Because it sounds confusing.
It was just as strange as the print itself. The stock sat completely flat in immediate after-hours trading. Clearly everyone was processing it, but then it broke out the next day, surging 5.8% to close at $44.81.
Well, the market definitely had to take a minute to digest the accounting there because, that headline EPS number, it's a massive illusion.
An illusion, how so?
Well, when you see a bottom line explosion of that magnitude, but without a corresponding top line surge, you're almost always looking at a one-time accounting adjustment.
Ah, right. Not a sudden operational shift.
Exactly. To understand the disparity, we have to look directly at the gross margin line. Karat recognized a $25.8 million one-time tariff refund.
Wait, $25 million? Just from a refund?
Yeah, under the International Emergency Economic Powers Act, plus about $0.9 million in related interest income.
Okay, I want to break down the mechanics of how that actually hits the income statement. Because, for the retail investors listening to this deep dive, this isn't just about having extra cash in the bank.
Right. It fundamentally distorts the operational metrics.
Think of it like finding a forgotten $100 bill in your winter coat.
Always a good feeling.
Right. It's fantastic for your wallet today. But instead of just putting it in your pocket and moving on, you call up your accountant and tell them to retroactively reduce last year's winter clothing budget by $100.
That is a great way to put it.
So it makes your current operating margins look incredible on paper, but your actual daily cash flow from your day job, it hasn't changed at all.
And that retroactive adjustment is the key here. Under standard accounting principles, this $25.8 million refund had to be recorded as a reduction to their cost of goods sold, or COGS, for this specific quarter.
Because it was reversing historical tariff costs they'd already absorbed.
Precisely. They paid those in prior periods. So because their COGS suddenly plummeted by $25 million on paper, their reported gross margin artificially skyrocketed to 56.6%.
Wow.
And their adjusted EBITDA hit $41.6 million, which is a 30.5% margin.
Which is just absurd for a company selling disposable food service products, right? I mean, packaging.
Yeah.
You do not organically command a 56% gross margin in a heavily commoditized physical goods industry.
Absolutely not. If you were just scraping the headline numbers off a stock screener, you might think Karat Packaging suddenly figured out how to sell software.
So how did management address this on the call?
They were forced to be very transparent about the underlying reality, just to manage future expectations. They explicitly noted that the underlying gross margin, excluding this tariff refund, was 37.7%.
Right, 37.7%, which is actually a very resilient number in a difficult supply chain environment.
It is, but it is a massive step down from that 56.6% headline. When you do the math on that $1.48 EPS beat, roughly a full dollar of that was purely generated by the refund.
Meaning the core operational EPS, the money they actually made from selling packaging this quarter, was closer to 48 cents.
Exactly.
Which sits perfectly within the 47 to 51 cent range Wall Street analysts originally modeled.
Yep. The core business performed exactly as expected.
Which makes that subsequent 5.8% stock surge really fascinating. If the tariff windfall is already in the rearview mirror, we have to figure out what is driving management's confidence in that, low double-digit revenue growth guidance for Q3.
Well, the growth engine right now is their e-commerce channel. And honestly, the underlying mechanics of how they are executing this pivot are highly unusual for a B2B packaging supplier.
In what way?
Well, overall online sales grew 23.6% year over year in Q2, but management pointed out a massive acceleration happening right now. In July alone, online growth hit 37% year over year.
That's a huge jump for 1 month.
And the real standout is their Amazon storefront, where sales jumped 49%.
Wait, 49%. I am stuck on that Amazon figure.
Yeah.
We're talking about a company that traditionally sells bulk pallets of cups, containers, and utensils to regional distributors, right?
Right.
And large restaurant chains.
Right. That's their historical bread and butter.
So the pivot to Amazon implies they are aggressively targeting the long tail of the market. Independent coffee shops, single-location food trucks, small catering businesses.
Exactly. Buyers who don't want to negotiate a complex B2B contract.
Right. They just want to click Buy Now on Amazon Prime and have a case of takeout containers show up tomorrow.
It completely bypasses the traditional B2B distributor network. And it captures a higher margin on the individual sale. I mean, even after Amazon takes its cut.
Which is smart.
Yeah. They are currently on track to exceed their $100 million online revenue target for 2026. E-commerce is no longer just some supplementary channel. It is fundamentally altering their revenue profile.
But capturing that Amazon buyer requires an entirely different operational backend, doesn't it? You can't service a 49% surge in rapid e-commerce orders using a legacy B2B supply chain built for slow-moving freight.
No, you really can't.
Because Amazon's algorithm dictates that if you cannot hit their aggressive delivery windows, you lose the buy box and your sales just plummet.
Right, which explains the heavy capital expenditure we are seeing on the physical infrastructure side. They're finalizing a new 47,000 square foot distribution center in Orlando, Florida.
Oh, okay. And that's slated to open in Q3.
Yep. The Orlando facility is really the missing puzzle piece for their Southeast fulfillment strategy. Right now, if a cafe in Miami orders supplies from Karat, delivery times are sitting at an uncompetitive 3 to 5 days.
Which feels like an eternity for an Amazon buyer.
Exactly. Management stated this new Orlando hub will slash that down to 1 to 2 days. In the e-commerce ecosystem, cutting transit time by 70% is how you lock in recurring subscription orders.
Okay, that makes sense. And it is not just how they are selling, it is what they are selling that is shifting the top line. Overall, volume growth and product mix added $13.1 million to revenue in Q2.
And a massive chunk of that is coming from their eco-friendly product portfolio.
Right, which now represents 33.8% of total sales, up from 31.8% last year. They are heavily expanding into new paper-based categories.
Which is a necessary defensive moat, honestly, as much as it is a growth driver. We are seeing municipalities globally banning single-use plastics.
Well, absolutely.
So having a third of your revenue already anchored in biodegradable and paper-based alternatives means you aren't scrambling to retool your manufacturing when new regulations hit.
Well, I have to interject here and look at the friction this creates. Eco-friendly packaging, particularly paper-based products, is generally heavier and bulkier than thin plastic.
Oh, for sure. It takes up way more space.
And that brings us directly to the fundamental tension in this earnings report. Revenue is up 9.9%, e-commerce is accelerating, but operating leverage is totally absent. Total operating expenses jumped 21.5% year over year to $39.6 million.
Yeah, that's a tough look.
Costs are inflating twice as fast as sales.
And the bears are highly focused on this exact divergence. A significant driver of that 21.5% expense inflation is domestic shipping and transportation.
Really?
Yeah, those costs rose sequentially by $1.4 million just from Q1 to Q2, hitting $6.1 million for the quarter.
Wait, if they are opening new distribution centers, like the one in Orlando specifically, to place inventory closer to the end consumer, shouldn't last-mile delivery costs be going down, not up?
You would assume localized fulfillment drops costs, but you have to factor in the shift to direct-to-consumer e-commerce we just discussed.
Oh, I see.
Shipping one massive pallet to a commercial distributor is highly cost-efficient. Breaking that pallet down and shipping 50 individual boxes via parcel carriers to 50 different independent coffee shops across a region. That is incredibly expensive on a per-unit basis.
So the e-commerce volume is cannibalizing their logistics margins.
Exactly. And the margin compression isn't just happening on the domestic delivery side. Getting the product into the country in the first place is getting brutal.
Let me look at the macro data here. Yeah, they're getting squeezed on two fronts. First, They saw a 4.3% increase in the actual volume of imported containers, which, aligns with the sales growth.
Right.
But the killer is the 8.9% spike in average ocean container rates. Import costs as a percentage of sales rose from 9.5% last year to 11.1% this quarter.
Global freight capacity is heavily constrained right now, and Karat is fully exposed to spot market volatility.
And compounding the physical shipping costs is the geopolitical regulatory burden.
Right. Yeah, we have new Section 301 tariffs of 10 to 12.5% looming over the imported packaging sector.
Plus, doesn't Karat have an unresolved customs and border protection duty issue?
Yes. Regarding their thermal paper imports, they actually have a $1.3 million reserve sitting on their balance sheet specifically attached to that CBP dispute.
So the narrative is incredibly strained here. They have domestic freight costs inflating due to the e-commerce pivot, ocean freight costs spiking due to global constraints, and the perpetual threat of new tariffs.
Got a lot of pressure.
Defending that 37.7% underlying gross margin feels like an uphill battle. How are CEO Alan Yu and CFO Jian Guo planning to stop the bleeding on the cost side?
They are executing a two-pronged structural overhaul. The first prong addresses the domestic logistics strain. They are actively shifting away from third-party logistics carriers and expanding their own internal fleet.
Like for local deliveries and inter-warehouse transfers.
Exactly.
But bringing logistics in-house is a massive capital allocation decision. You are buying trucks, hiring drivers, dealing with insurance and maintenance.
It requires heavy upfront capital, absolutely.
But it changes your cost structure from variable third-party premiums to fixed internal costs. Over time, as volume scales, the marginal cost of putting one extra box on your own truck is virtually zero compared to paying FedEx or UPS.
Right. It gives them ultimate control over their last-mile unit economics. Management also noted they are getting a much-needed macro tailwind on this front, too.
Oh, with fuel prices.
Yes. Diesel fuel costs peaked at a painful $5.40 per gallon in Q2, which heavily inflated those domestic shipping numbers. However, diesel is dropping closer to $4 a gallon in Q3.
Wow, that represents roughly a 25% drop in a core input cost. That will provide immediate margin relief for both their internal fleet and their remaining third-party freight contracts.
It is a lucky macroeconomic break. But the second prong of their strategy, the sourcing diversification, is purely operational heavy lifting.
What are they doing there?
They are aggressively decreasing their reliance on Chinese manufacturing, mainly to shield the company from the looming Section 301 tariffs and the CBP thermal paper disputes.
But the scale of that kind of supply chain re-architecture has to be staggering.
It is. China is now down to just 11% of their total sourcing.
I need to pause on that. 11%. That is remarkably low for a company that built its entire business model on importing cheap, manufactured disposable goods.
Yep.
Shifting that volume requires finding new factories, establishing new quality control protocols, securing new shipping lanes. Where's the volume actually going?
They have transitioned the bulk of the manufacturing to Taiwan, which now makes up 46% of their sourcing.
Okay.
Additionally, they've pushed domestic U.S. purchases up to nearly 20%. The remaining 12% is scattered across a mix of emerging manufacturing hubs like Indonesia and South America.
Sourcing 20% domestically is the ultimate hedge against trans-Pacific freight spikes. It might cost slightly more to manufacture a paper cup in the U.S., but when ocean freight rates spike 8.9% in a single quarter, that domestic premium suddenly looks like a bargain.
It builds incredible resilience into the balance sheet. When your supply chain is highly distributed, a port strike in one region or a localized tariff hike doesn't paralyze your ability to fulfill those critical Amazon orders.
Right.
They are basically sacrificing some absolute gross margin potential for supply chain certainty.
Which brings us to the most controversial part of this entire earnings report. If you're looking at this stock as a potential investment, you have to weigh the rapid organic e-commerce growth against this massive, expensive supply chain overhaul.
It's a delicate balance.
And the way management decided to signal their confidence to the market was through a very aggressive dividend hike.
Oh, yeah, this is the big one.
They raised the regular quarterly dividend to 47 cents per share, which comes out to $1.88 annualized.
Now, in a vacuum, raising the dividend signals that management expects strong, sustained free cash flow. But when you apply that new dividend to their actual financial reality, you uncover a massive bearish risk. At 47 cents per share, their dividend payout ratio spikes to a highly elevated 113.92%.
Let's clearly define the mechanics of what a 113% payout ratio actually means for the balance sheet. It means for every dollar of net income Karat generates from selling packaging, they are paying out $1.13 to shareholders.
Yeah, you cannot organically sustain that.
They are essentially draining cash reserves to fund the dividend yield.
And the bear thesis hinges entirely on this metric. Skeptics argue that management is using the $25 million cash windfall from the retroactive tariff refund to subsidize a dividend yield they cannot actually afford based on core operating cash flows.
So the moment that one-time IEPA refund money is spent, the business has to fund that dividend entirely through its operational margins.
Exactly.
And as we just covered, those operational margins are under heavy siege from rising domestic parcel shipping costs and spiking ocean freight rates.
Right. If the internal fleet strategy takes too long to scale, or if the new Taiwan-based supply chain hits a speed bump, the cash flow won't be there to support a 113% payout ratio.
They would be forced to cut the dividend, which historically triggers a brutal stock sell-off.
And this underlying tension is perfectly reflected in the massive disconnect between Wall Street analysts and the current retail market price.
How far off are they?
Well, following the earnings print, institutional analysts largely maintained a hold rating on the stock. They are heavily factoring in the tariff asterisk, the 21.5% inflation in operating expenses, and that precarious payout ratio.
Right.
Because of that, the institutional average price target is sitting at $36.50.
But the actual market closed at $44.81. The stock is trading roughly 34 to 35% above the institutional consensus target.
It is a classic market tug-of-war.
The retail traders saw a 200% EPS beat on the headline, saw an aggressive dividend hike, and bid the stock up immediately.
Exactly. While the spreadsheet analysts are looking at the cash flow mechanics of a 113% payout ratio and refusing to adjust their targets upward.
It illustrates exactly why looking past the headline beat is so critical during earnings season. The headline tells you what happened in the past. The margins and the capital allocation tell you what the company is risking in the future.
And not have said it better.
Which leaves you with a final thought to mull over as we close out this analysis. Think back to that $100 bill in the winter coat. It's spent.
Long gone.
Right. The financial glow of that $25 million tariff refund is going to fade completely over the next 2 quarters. When it does, and the business has to stand on its own 2 feet, can Karat's booming organic Amazon growth actually generate enough cash to outpace its rising freight costs and that massive dividend burden?
It is the ultimate stress test for their new decentralized supply chain and their aggressive pivot into e-commerce fulfillment.
Because if it can't, that 34% premium over Wall Street's targets is going to evaporate very quickly. We'll be tracking their cash flow metrics closely in Q3 to see who wins the tug of war. Thanks for joining us for this deep dive today, and make sure to follow the show for your daily earnings coverage so you never miss the actual mechanics behind the headlines.